Hello, everyone, and welcome to the first virtual session of this year's Refugee and Immigrant Volunteer Summit. This is the 6th annual RAVES for short, which is just a really delightful acronym. It's so nice to see many names and faces that I already recognized from this morning. We had a really lovely keynote session and a breakfast together. For those of you who are just joining us now, it is so nice to have you on this first virtual session. Before I introduce our speaker, I do want to remind you, as Helen has just said, that we are going to be recording these sessions, and these recordings will be available for participants a little later in the week, but particularly if you're thinking about what you might be sharing with your name or your image, things like that, we just want you to know that the recording is in process. A few quick things about RAVES, especially for those of you who are joining us for the first time right now. This is a community summit hosted by Reestablish Richmond in partnership with the Afghan Association of Central Virginia, the African Community Network, the International Rescue Committee, the U.S. Committee for Refugees and Immigrants. And this summit over the course of the next 2 days will focus on strengthening allyship and community through education and professional development. And for our virtual sessions, we're really lucky to be kicking things off today with Nancy Rossner. Nancy is a senior attorney with the Community Tax Law Project, which is the first independent low-income taxpayer clinic in the nation. She received her BA Summa Cum Laude from the University of Binghamton, the State University of New York, her JD from the University of Richmond, the T.C. Williams School of Law, where she served as the annual survey editor for the Journal of Law and Technology. And in a moment, when I hand things over to Nancy, she'll be talking about the tax lives of Uber drivers and other gig economy workers. Before I do so, Nancy, I'll just remind everyone that you can feel free to start leaving questions in the chat during the talk. I will be monitoring things there. And then once we've heard some really exciting words from you, I'll help monitor the Q&A so that we're able to be in a really robust discussion together. Nancy, I will turn things over to you.
Great. Thank you so much, Katie. And thanks everyone for being here with us today. I'm really happy to be here, especially to present on the tax lives of Uber drivers. First, I just wanted to tell you a little bit about us, and I will go ahead and share my presentation. In a minute since I've done this. Here we go. Okay. So just a little bit first about our tax clinic. We're a low-income taxpayer clinic here in Richmond, but we do serve the entire state of Virginia. We're similar to like a legal aid organization, but we focus strictly on income tax issues. So that could be issues with the IRS or with the Virginia Department of Taxation. Our mission is threefold. We focus on free legal representation and brief advice for taxpayers in Virginia, and that includes both documented and undocumented workers. And then we also focus on tax education to taxpayers and other community organizations serving taxpayers, as well as outreach, especially to English as a second language speakers in Virginia. All right, so today's topics, we're going to talk about what is taxable self-employment income, independent contractors versus wage earners, what is the difference there, filing thresholds, reporting and tracking business income and expenses, making estimated tax payments, and free income tax return preparation resources. And I am happy to make this presentation available after this session because I really do want this presentation to also serve as a resource as you're helping folks in the community. So first, what is taxable income? You may be used to some of these, wages, if you're a worker getting a W-2, salaries, commissions, gambling winnings, even bank interest if you're earning interest on money that's in a bank account. But another important form of taxable income is self-employment income, also known as income earned by an independent contractor. So I will use those terms sort of interchangeably during this presentation. Someone who's self-employed or someone who's an independent contractor, it's pretty much the same thing. But basically, it's someone who is working for themselves and does not have an employer that they're reporting to. So what is an independent contractor? By definition, an independent contractor is a worker that has more control. They have control over what work they'll do, how they'll do it, and when they'll do it. And that's different than a wage earner who may have to report to work at a certain time and is told exactly what needs to get done during the day and how to do it. So someone who's paying an independent contractor or self-employed individual has a little less control over the work that's being done. They have control over the end result, really. But as far as the process, the control is more so left to the independent contractor. And so when you get into questions of whether someone is a wage earner or an independent contractor, IRS looks at that control factor. And sometimes there is confusion. Someone can be misclassified. So sometimes someone should be getting a W-2 and maybe treated as a wage earner for all intents and purposes, but then at the end of the year, they get a 1099 signifying that they're being treated as someone who's self-employed. There are some problems with that, and we'll get into that. But there are ways to actually file a claim, even with the IRS, that you have been misclassified. But essentially, the point of this, presentation today is to talk about Uber and Lyft drivers, other sort of ride share workers. So drivers for companies like Uber or Lyft are currently classified as independent contractors under the law. There have been some lawsuits you may have seen in the news over the past couple of years, especially in California, where they've been trying to get workers classified differently as wage earners or employees, or just get them some maybe heightened benefits. But so far that has not been passed. So technically, if you're someone who's doing rideshare work, you are treated as self-employed or an independent contractor, or someone may even call you a sole proprietor, meaning you have your own business. And I think a lot of people are like, wait, I don't have my own business. I work for Uber. But because of the way that you're being paid and the control that you have over the work, that really would be the proper classification. And that is the way that you would report your income at the end of the year. So some other examples of similar companies that have sort of a similar workforce would be companies like DoorDash, Postmates, Instacart, and Uber Eats. So what are some of the primary differences between a wage earner and an independent contractor? Well, first off, if you're a wage earner or you're also known as an employee, you get a Form W-2 at the end of the year. You can also request that your employer withhold money from your paycheck in order to pay federal and state income taxes. You would do that by filling out the Form W-4 for your federal tax and Form VA-4 for your state tax. And a lot of times that may be included, in it when someone first starts a job in some of that early paperwork, but that tells your employer how much should be taken out of your pay and essentially set aside for payment of taxes when the return is filed at the end of the year. Another important factor, another important difference, I should say, between employees and independent contractors is that when you're an employee, your employer actually contributes to your FICA withholding. And the FICA is essentially your Social Security tax and Medicare tax that's getting taken out of your paycheck. So if you ever look at a paycheck and you see all of these deductions coming out, it always feels like there's so many deductions coming out. But usually some of the biggest ones are the federal withholding, the state withholding, but also the FICA and the Social Security tax that's coming out. And so it's important because the employer is actually paying 1/2 of that. Whereas if you're an independent contractor, you're actually responsible for 100% of that. Additionally, the employee on both sides is responsible for income tax. But when you're an independent contractor, you are also responsible for self-employment tax. And because you don't have an employer that's taking the taxes out of your pay and paying it to the IRS or paying it to Virginia, when you're self-employed, you are actually the person who is responsible for doing that. So there really is more responsibility on someone who is self-employed to really stay on top of things and make sure that they're kind of keeping in mind how much they're earning and what that may translate to in terms of how much tax they may owe both to the IRS and to the state income tax department. So we mentioned here, and I think later, that estimated tax payments are required. So those would be quarterly payments that you can make to essentially prepay your tax, much like you would do with withholding, except when you're self-employed, the responsibility is on you to go ahead and make those payments. Those payments can also be made, when you file your tax return. However, if you fail to do so and you can't pay the tax when you file the return, you may also be penalized for not making those estimated tax payments ahead of time. And I am happy to answer questions like during the presentation. I don't know if that will throw you off at all, but feel free, because I know we'll be covering a few different topics here. And
Nancy, can I jump in to ask if we do see stuff come up in the chat? I know that can be hard to see when you're screen sharing. Would you like me just to pause and
Sure.
review the question?
Sure,
Okay.
Yeah, that would be great. And I'll try to keep an eye on that too. So some more differences between wage earners and independent contractors. Independent contractors can work for different companies at the same time. They usually are using their own tools and resources. So for this example, for ride sharing, that may be things like your own car, your own phone, in order to run the app. There's no union option for independent contractors. Again, they're personally responsible for more taxes. So when I say that, I just mean, they don't have the employer that's contributing 1/2 to that FICA tax. They're responsible for 100% of that. And there's no paid time off. So if you're working, you're earning money. If you're not working, you're not earning money. Employees, on the other hand, they earn at least the minimum wage. They often do receive paid time off, and they may be eligible for certain benefits like health insurance, disability insurance, and even maybe free to join unions. So there are some other differences when it comes to filing taxes when you're looking at someone who's a wage earner versus someone who's self-employed. So on this slide, we're looking at the filing thresholds. And what a filing threshold is basically, once you make that amount or more, as listed on the slide, you are required to file a tax return. If you're making below that, though, you're actually not required to file a tax return based on that particular filing status. So someone who is single and made $10,000 in wages for the year 2022 actually is not even required to file a tax return based on their income for the year. However, there can be reasons why you would want to file a return anyway. If you had withholding that was taken out of your paycheck, you would need to file the return to get that back to you in a refund. And there's also credits, especially if you have children, there's credits that are geared towards low income workers that can often produce thousands of dollars in refunds. Some of those do require social security numbers. Some of them do not, or may only require a social for the child if you're claiming a child. But when it comes to the thresholds, I think you'll see there's a huge difference between someone who's a wage earner, which is like the first bullet point, and someone who's self-employed. There's a much, much lower standard. So we're talking about annual income here. So for the year, someone who's self-employed, once they've made $400 in net self-employment income, so after expenses are taken out, once they've made $400 for the year, they are required to file a tax return. So it's much, much lower than someone, who may be a wage earner. If they made $400, they would not be required to file a tax return. You may be wondering why that is. I think maybe in part because the IRS has, less ways of sort of keeping track of self-employed individuals, because some of that income may not be reported to the IRS. And so there is a more stringent standard when it comes to actually reporting the income on your tax return. Oops. So filing taxes as an independent contractor, what are we talking about here? Most often, you will still be filing the same type of tax return, but you will be attaching a schedule reporting your business income and expenses. So it's not that it requires an entirely different business tax return unless maybe you've incorporated as like a corporation or a partnership. If it's just a single person and you know, there's no employees, they're just, you know, doing the ride share, getting the income themselves, they don't have subcontractors maybe, you know, then typically you're going to be looking at someone who's filing, you know, the same type of form that a lot of us are filing. It's a Form 1040, and then they're reporting their business income and expenses on a separate schedule, Schedule C, that has, you know, it makes some calculations that then come onto the actual Form 1040 where it lists the net business income. All right, so what is business income? So we're talking about, you know, self-employment work. So you're getting paid for services that you're doing as an independent contractor, a self-employed person, not as a wage earner. And how is that reported to someone? So it actually could be reported on a few different types of tax forms. There's the Form 1099 miscellaneous, which I think maybe a lot more well-known, which is for reporting sort of miscellaneous income. But in 2020, the IRS decided to revive a form that they used to use, Form 1099 NEC, and start using that again for someone who's self-employed. So up until that point, when someone was self-employed, most often they were getting their income reported on a Form 1099, and then they would use that to report their, you know, calculate and report their business income on their tax return. But now we're seeing the use of the Form 1099 NEC, which stands for non-employee compensation. Again, because they're not employees, they're independent contractors. So you may see that form getting used a lot more now to report earnings for someone who's self-employed. And then the third type of form you may also see quite a bit with, especially with someone who's doing rideshare, the Form 1099K. And that form reports income that was processed through like a third-party processor. So a lot of times, like if someone is processing through a credit card, you know, you're going to see those amounts being totaled up and reported on the Form 1099K. So that is another form that does report income. So you would really be totaling up all three of these when you're trying to determine, okay, what is my gross, my total business income for the year? In addition to that, business income may also include money you were paid in cash or checks. So things like tips actually are supposed to be reported to the IRS as well, even if they are being received via cash or check and not reported on a 1099, one of these different 1099s. Okay, so I thought it would be helpful just to show you what these forms look like. So this is an example of a blank form 1099K. Can you see my mouse moving? Okay, great. So in this section is where you'll see the filer's name. The filer is like the person that's paying the independent contractor. And then here you'll see the person who's being paid. You'll see their name and address. Here you'll see the filer's tax identification number. Here you'll see the payers, the person receiving the funds, their tax identification number, which, you know, may be a social security number or potentially an income tax identification number if they don't qualify for a social. And then box 1A totals up all of the transactions for every month of the year. But you'll see down here in these other boxes, under 5A through L, they actually break it down by month as well. So that, you know, you'll see the different earnings according to month, but then it's all totaled up into box 1A. So typically when you're looking to, okay, what is the total amount that I received through these third-party transactions in the year, you're going to be looking at the box 1A. I will pause if there's any questions so far. Okay. So moving on to the next form, this is the NEC, the non-employee 1099 NEC for the non-employee compensation. So this is the one we're going to be seeing a lot more now moving forward to report independent contractor work. So again, we've got the payer's name, the person paying the independent contractor, we've got their tax identification number, then you've got the driver's tax identification number, their name and address. And here is where they would report the total employee compensation or non-employee compensation for the year. And I do want to draw your attention to box 4. So it does list federal income tax withheld. Now, typically an employer is not required to withhold any income for payment of taxes. You know, we went over sort of the differences between wage earners and someone who is employing wage earners are, you know, they are required to withhold if the employee directs them to, but someone who's paying an independent contractor is not required to do so. However, they can agree if both parties would like to, if both the worker and the payer, you know, are willing to agree to have taxes withheld, it is possible to have taxes withheld, even though you're working as an independent contractor. But it is more work for the person paying you, so I'm not sure how often you'll see that in terms of them agreeing to do the withholding. Okay, and then lastly here we've got the Form 1099 miscellaneous. So this may be one that you've been used to seeing a little more often if you've reviewed the documents of someone who's self-employed. This is where the person paying them would list their name and address, their tax identification number. The person getting paid, this is where their social or income tax identification number would go. The person receiving the payments, their name and address would go here. And then you'll see maybe why they started to use the Form 1099 NEC again, because the Form 1099 miscellaneous reports a lot of different types of income. So rents, royalties, other income, fishing boat proceeds, medical and healthcare payments. So there's really a lot going on this form. Usually in the third box for other income is where you would see someone who's an independent contractor. That's where you would see their income being reported in that box 3. So again, I don't think you're going to be seeing this one as much anymore. Okay, so now I thought it would be helpful to look at the Schedule C. So this is the form that a taxpayer would use to report their business income to the IRS. And this form would be included in the tax return that they submit. So they would list their name, the type of service that they're providing. If there is a business name, they could provide it here and a business address. You'll see here they request the social, or if they have, if they've registered and gotten their own tax identification number as a business. And then you can enter codes to sort of identify what type of business it is. There are some questions about when the business was started, the accounting method, which is usually going to be cash accounting method if you're just going from year start to year end. And then under part 1 is where you would report the income. So mostly you're going to be totaling up the 1099s, the MISC, the NEC, the 1099K. You're going to be totaling all of those up, and you're going to be reporting that in box 1. Now, I don't think someone who's doing rideshare through their rideshare business is also selling goods. So I don't think you're going to be using, you know, box 4 or anything. So I think in most cases, box 1 is going to equal box 7. You're reporting the total gross income for the business. If someone had like a different kind of business where they're getting paid for a service, but then they're also selling goods, that's where some of these other lines come into play. But I don't think you're going to be seeing that. So here I've got some examples just from some clients that I have had of what they may be able to access through the app. So this is a weekly statement from one of my clients showing what their weekly earnings was. So we've got the total earnings, and then we've got the payout, which is the amount that was transferred, into their bank account. So this isn't so much to use for tax return preparation, but it is something that they can use to try to be mindful of and track sort of what their earnings are along the way. And then Lyft has a very similar type of form. So this one includes a bit more, actually. You've got the net earnings, after expenses. So here we've got the total ride earnings was $496. Then they also had some tips on top of that, some bonuses on top of that. I know sometimes there's different incentives where they, if they do a certain number of rides or, there's certain incentives where they can earn bonuses. They've got some cancel earnings here. So I don't know if that's someone that ordered a ride and then later canceled. And then some express pay fees, which I'm not sure if that's an internal Lyft fee. But we will talk about the fees because a lot of these fees are actually going to be deductible business expenses on the tax return. And so we can see the number of rides, how much time they were online, so how much time they were using the app. And then here we've got the net earnings, and that was for 1 week of work. So now I'd like to show you the expenses portion of the form Schedule C for the 1040. We were just looking at the top half of the form, which was the income section. And now this is a portion of the bottom half of the form, which is actually where someone would report their expenses, just to give you an idea of what type of expenses someone may be able to claim. So you'll see things like advertising, car and truck expenses. I think that's really going to be the number one expense when you're talking about someone who's doing ride share, because that would include things like mileage, which is typically going to be their biggest expense. But you'll also see right below that on line 10 is commissions and fees. So any fees that are being taken out by the payer, would also be deductible as a business expense here. I guess someone who is leasing a car, I think there are situations where you can lease a car maybe directly from the ride share company. That would be potentially deductible here, as well as some certain taxes and licenses, but it kind of depends on how you choose to deduct your car related expenses. There's a slide on that in just a little bit. Okay, so some common deductible expenses for Uber drivers. Number one, as you can see, the emphasis is on mileage because that's usually going to be the biggest one. And so there are two ways that you can look at mileage, and one way is definitely way easier than the other. The first way is to claim actual costs. So costs like gasoline, oil, insurance, car registration, repairs, you'd actually have to keep all of those receipts and separate them out, and then probably take a percentage of that based on your business use of the car, like how often you're using the car for business versus personal use. That I think is going to be a lot harder, and I'm not sure that it's going to be worth it to go that route. So the second option is usually a lot more preferable, which is just claiming the standard rate for the year. So it's a much easier calculation because you're basically just taking the amount of miles that were driven for the business use, and then you're multiplying it by the business mileage rate for that year. I use 2021 as an example here because 2022 into the year, they actually increased the business mileage rate, I think because of gas prices and costs going up. So that was going to be a little more of a complex calculation, not much, but just to simplify, I used the 2021 business mileage rate, which was a bit lower at 0.56 cents per mile. So for example, if someone drove 1,000 miles in the year and they multiplied it by the business mileage rate, their expense would be $560 for the year, and you could take that as a business deduction. But that would include, that is supposed to include basically like the cost of insurance, registration, et cetera. So you're not going to be able to claim that on top because you're doing this like simplified calculation. Whereas, you know, you could do the actual, but I think it's just a lot harder. And I don't know if in the end it's going to be worth it. So the second common deductible expense is going to be Uber and Lyft. And I'm just using those as an example. Obviously, there's other companies that do this type of work, but I think these are the ones we see most often. Their fees and deductions. So as you can see, I mentioned here, they do usually include it on the dashboard, and you'll see they also include it on an end of year summary that is a different document than the actual 1099s that the driver would receive. So it is a lot of information. And I think if you don't know that that exists or where to look for it, or that it can be used when you file your taxes, you can actually be missing out on some important business deductions when you go to file your tax return. Business use of cell phone. So that one's a pretty straightforward calculation where basically you're identifying what is my monthly cost of using my cell phone. So that may be, you know, just your cost of service, you know, so I used $100 a month as an example. And then let's say the taxpayer estimates, well, I think I use my phone throughout the year, 25% of the time I'm using it for business. So you would just make a calculation, 25% of $100 a month over the course of the year. And that's how you would determine, you know, what is your, which I think is $300 for the year. That's how you would determine what your cell phone expense is. And I think cell phone falls under one of the other expenses on Schedule C. There is a section for other expenses. Things like snacks and refreshments for passengers would also qualify as an other expense. In that case, it is important to keep receipts and to show that it's not like you're just going grocery shopping for your family. You would need to identify and only claim expenses for those separate snacks and refreshments that you're providing to your riders. A couple other examples I thought of sometimes when I've taken rideshare rides, sometimes they'll hand out a business card. Business cards cost money to print. So I mentioned advertising and marketing materials because that is potentially another deductible business expense, or maybe if someone's printing flyers, something like that, that could be deductible. And then I think something that's still very relevant is personal protective equipment, or PPE. So, you know, if drivers are using masks, face shields, hand sanitizers in order to keep themselves safe when they're driving strangers around, the cost of those items can also be deductible. But again, you know, the taxpayer needs to be maintaining those receipts if it later gets called into question, but also so you know how much to claim as a deduction on your tax return. Any questions so far on that?
And Nancy, we do have a question in the chat from Marilyn. So I'll just read it for you. With the increase in the allowable deductible in 2022, would the driver need to clearly delineate when the miles were driven as they estimate their deduction? So given the switch, how does that, well, what kind of documentation would need to happen there?
I'm not sure what you mean by this switch.
I think you mentioned that there was an increase in the mileage
Oh, yes. Okay.
So
I'm
how
sorry.
would that be
Yes.
documented if someone were working on 2022 returns?
Oh, good question. I think you would just, need to, I think you would still just put the amount that you calculate, but in your notes, you would have to look at how many miles were driven in the first half of the year that, under one business rate, and then how many miles were driven in the second half of the year under the other rate. And I wonder too if the tax prep software may do that calculation for you. I don't know the answer to that because I haven't done a Schedule C yet for the current year. But it's also possible that maybe the software would try to capture that, since that is a different calculation. But I think what a driver could do is maybe going back to those like weekly reports that I was showing you. They could total up the weekly reports, up until the point that the rate switched, and then total the rest of the year with the new rate and just have that calculation. But I think, you would really just be putting what you think is the right answer on the form. And then only if the IRS later calls it into question would you have to go ahead and like provide the proof of your calculation.
Awesome. And thanks, Marilyn. That's a great question.
Yeah, great question. Okay, so this is a tax summary from one of my clients that we had. And so I don't know how much different this might look. I have a feeling it's probably pretty similar to the folks that are driving now. But this is a separate document that they would get from the rideshare company that is different than the 1099s that we talked about. Because as you'll see, it kind of summarizes a lot of the information. And this form becomes really important because it lists expenses that the taxpayer can claim on their tax return that I don't think would be listed anywhere else. It doesn't get reported on the 1099K, the miscellaneous, or the NEC. So when you're, trying to advise a taxpayer, maybe you're not doing the return. I'm not expecting y'all to do the returns, but to help them to gather the right documents to go to their preparer, whether that's like the VITA program, which I have a slide on later, or to a paid preparer, or maybe they have someone they trust that's going to do the return that has training. It's a really important document to have. So I'll show you here why. Here in this section, these are all the fees. So there's quite a bit of fees here, as you can see, about more than $1,500 in fees that they would get to deduct. Why all these deductions are important is because you subtract these deductions from the gross income, and then what's left over is what is taxed by the government. So the more expenses you have, the more legitimate expenses you have, the less of your income is taxed, and ultimately the less tax you'll pay when you go to file your tax return. So here we see, they can total this up and they would report that on the Schedule C under the commissions and fees expense, which was that one right below the mileage. Here, they also total up like the earnings. So you'll see the gross fare plus the fees and the total. This is what's being reported on the 1099K to the taxpayer. So something folks may not realize is that when they're getting those tax forms, those 1099s, that's the company reporting everything to them, not taking out the expenses. And that's why you get to deduct it on your business expense. So it's not that the taxpayer actually received, $11,300 and oops, oh dear, what did I do? Oh, okay. It's not that the taxpayer received $13,026 because before they got their pay, all of these fees were taken out. So they actually received $11,341. So the companies are reporting the total amount. They're not reporting the amount after these expenses were taken out. So that's why they get to claim it on the return. And that's why it wouldn't be, financially beneficial for them to only claim the amount on the 1099K, because basically you're getting taxed on money that includes fees that, you know, you're not getting paid those fees, the company is getting paid those fees. So if you remember, the 1099-K reports payments that were made through third-party payment transactions. So like if they're swiping a credit card or using another form of payment, that's what's getting reported on the 1099-K. But someone could also be receiving a 1099 miscellaneous or a 1099 NEC from the company reporting things like referrals, incentives, bonuses, things like that. So that's why when you're reporting all of that, you have to do the total of the 1099-K and the 1099 miscellaneous, because those represent different payments that the driver is receiving. And so we total up these two in order to come up with the earnings. And then here we see some other potential deductions that's in a completely different section. Here is the Uber service fee. So this is the fee that Uber is taking out, maybe just because you're driving Uber and you're using their platform, you know, or you're using their name in order to get riders. They're just taking out sort of a flat fee. That's another fee that you would get to deduct on your tax return. And then lastly, you'll see here that the app tracks on-trip mileage. Now, I think nowadays it may track more than on-trips. I think what on-trip means or meant at that time was just mileage you were driving with someone in your car. But there's other business mileage that someone may be eligible to deduct, which includes the mileage that you're driving when you're driving around looking for someone, or maybe the mileage between you dropping someone off and you driving to the new person. That's all business mileage. You're not doing that for personal use. You're doing it for the business. And so I'm not sure nowadays if the app, I don't think the app tracks all of that. And so you'll see on another slide, we recommend that it is possible if someone wanted to use additional applications to track business miles, because what's being tracked in the Uber or Lyft app may not account for everything that they're driving for work. And so they may actually have an even bigger mileage expense than what's being reported on the tax summary. And I think we have a question.
Sorry, I didn't unmute quickly enough. It looks like Spencer is saying, oh, maybe it does track. I think, Spencer, it sounds like maybe that's what you're responding to, is it might track within that.
So I haven't driven in a month or so, but I drove Lyft and Uber, and I think they started actually telling you and giving some credit for the drive to the ride. So I think
now, what about the drive when you don't have a ride lined up and you're just kind of driving around waiting for a ride?
No, that's not calculated in any way, shape, or form. Yeah.
Okay. Yeah. So that would be an additional business expense. And that, you know, there are other ways to track that, whether you want to do it through an app or you note your odometer when you start work, and then you note your odometer in a notebook when you end work, you know, and you keep it in a separate notebook with the date and a detail of like what you were doing, you know, which is driving for, you know, Uber or Lyft. And that could be a record that the IRS would accept later if there was a question about what your mileage was. But I'm told that there are other apps that you can use to also track mileage. I'm not sure if you folks are familiar. I am not familiar, so I am not like advocating for these because I don't have personal experience, but apparently there's apps like Stride Tax and Mile IQ. One of them's free, one of them's not, that can help you to track mileage. So that may help you to capture mileage outside of, you know, everything that your platform is capturing, which it sounds like is more than they used to. I think like in the really early years, they weren't capturing as much, but now I think they realize to make it better for their drivers, you know, there's a lot of information they should be capturing and summarizing for them to make it worth their while, you know, to drive for Uber or Lyft. Here we've got just some tips for keeping track of deductible expenses, making sure that you're reviewing your driver dashboard, keeping receipts for things, I think potentially, I think you can make an argument, things like paying for a car wash, you know, maybe you could take that as an expense, or maybe like a percentage. If you're saying my business use of my car is 25%, maybe, you know, 25% of all of my car washes for the year. Because I know there's an expectation that the car is clean and, you know, looks like something someone wants to ride in. Having a system to track your tax deduction. So there's apps for tracking expenses. I think there's some where you can take photos of your expense, and that way it's all in your phone. Obviously, the danger there is that if you lose your phone, or you have an issue with your phone, or it's stolen, then there goes all of that information. So you may want to have like a backup, even if it's just like a folder at home. Keeping a separate bank account or credit card for business, and strictly using that only for business purposes, would be an option there. And then I already mentioned using apps to help you. Another thing I will mention is that typically things like food are not going to count as a business expense unless you're, at least an hour away from home. So someone who, is like working and they want to take an expense for the cookout that they got for lunch, something like that is typically not going to be an appropriate and deductible business expense. So we're just going to touch upon making estimated tax payments briefly. So I mentioned earlier that because you don't have an employer who's taking money out of your paycheck for payment towards taxes, really the responsibility is on you, the driver, to be making those payments. So really, if you're expecting to owe $1,000 or more in tax, you should be making those quarterly payments that I mentioned earlier, because if you don't pay enough, you may end up being charged a penalty by the IRS, which is just like additional money that you would owe. But there is a form. It's actually like a multi-page document that you can find just by Googling or going to the IRS website, IRS Form 1040-ES. It has a lot of information. Here's just a little picture of the top of the form. But it has a lot of information about trying to calculate like what you think you're going to owe in taxes. And it also includes these little voucher payments that you can rip off or cut out that you can then mail into the IRS to make sure that the payment is being applied to the right year. You don't want to just mail in the payment to the IRS, because then the IRS is going to apply it however they want. So mailing it in with this voucher, and also indicating on the check or the money order what year the payment's for, and the social or tax ID number of the person is also a good way to make sure that your payment is being applied properly by the IRS. So here are the due dates. And then there's just a little tip that I got from the 1040-ES that you can make more than 4 estimated tax payments. So actually, for some of my clients that have a hard time, I'll say, keeping up with their estimated tax payments, I think it is confusing to try to think about something quarterly. It's like, and then the way that the months are, it's like, what month am I paying this for? And, but I'm paying in 1 year, but that's for the end of last year. I think it gets confusing. So I've advised clients in the past just to make a monthly payment. And, you can photocopy that voucher and mail it in with your payment if you wanted to do more of like a monthly payment. I think that that's more helpful maybe in like the second year of doing Uber or Lyft or something like that, because you already have a sense of your earnings and how much tax you might end up owing. So then you can kind of like calculate like, well, if I'm basing it on last year, we can actually help someone figure out, like, if we look at last year's return and we're projecting this year to be about the same, we can help you try to figure out, okay, how much on a monthly basis, should I be paying? Because I think it's a little easier to think about it on a monthly basis. But you can also do that calculation by looking at the tax return and looking at the tax owed and really just dividing that by 12 months. And, the tax owed and multiplying that by, dividing that by 12 months to figure out what the monthly payment amount would need to be. Okay, so we're just approaching the end of the presentation here, but I wanted to make sure to mention some resources that we have here in our community. The first two, VITA and Tax Counseling for the Elderly, these are federally funded programs that provide free income tax return preparation at different sites throughout the state of Virginia. There's a few different ways that you can try to figure out what sites are near you by calling the phone numbers provided. Oh, I'm sorry, I meant to include the AARP website, but if you go to their website, you can search for the site locator tool. And the way the tool works is you click on it and you enter in your zip code and you enter in the radius that you're looking at, you know, within 5 miles, 10 miles, and so forth. And it'll tell you what sites are nearest you. It gives information like the phone number and the hours of operation and that sort of thing. So that can be a nice resource. Also, www.getyourrefund.org is another really great resource that really started in 2020, so during the pandemic, where folks can communicate with someone over the internet who will prepare their tax return for them for free. So it's kind of like going to a VITA or going to one of the TCE sites, but you're actually doing it all through the internet. So you don't actually have to physically go somewhere. But you're providing the documents, maybe you're communicating back and forth and answering questions. So I think there does need to be a little bit of know-how in terms of technology there, because you do have to provide images of the required documents. But sometimes that can be a really great resource for people that may have trouble getting to one of the physical sites. And those do, you know, some of them require appointments, and so those can book up, and then some of them may allow for drop-ins, but you know, sometimes the line can be quite long. So that's just another resource. And then lastly, a tip I was given is that you can also call 211 and find out what free tax prep sites are in your area. So that's another option there. So before I wrap up for the day, my last couple of slides are just about what are some questions that you can ask your tax preparer to make sure that everything's on the up and up? Because a lot of what we see at our clinic, or I shouldn't say a lot of what we see, but we've got a decent portion of folks that come to us because they went to a preparer or a quote unquote preparer who really made a mess of their taxes, or who, you know, were what we call unscrupulous preparers. They kind of just like did what they wanted on the return. Maybe they were trying to skew things to get a good refund so the person would want to come back next year. But ultimately, when you're the one signing the tax return and you're getting a bigger refund than you should, if IRS later catches that and you know, corrects it, you're the one that's going to owe the tax back to the IRS, even if it was the preparer that was advising you incorrectly. So just some questions you can ask. Are you registered? Are you a CPA, an enrolled agent? Those are, you know, you have to take a test and you have to get that certification. Do you have a P10, which is a number that's assigned by the IRS to tax preparers that they're supposed to put on the return? What documents do you need to prepare my return? What is the service fee? Is it a flat rate or based on the refund amount? The service fee should never be based on the refund amount. It should never be a portion of someone's refund. It should only be a flat service fee. So if someone's charging a portion of the refund, that's actually, you know, against the law, and they shouldn't be doing that. Another question, are you going to be around after tax season? What if I have an issue in a month? You know, am I going to go to the building and no one's going to be there? Because there's definitely these like fly by night, you know, operations where they do the returns and then they get out of there. Some other questions. When will I be able to review and sign my return? A taxpayer should always have the opportunity to review their return before signing it. Will the preparer also sign the tax form once it's completed? A paid preparer is supposed to put their information on the return. So if someone is paying someone to do the return and they're not putting their information as a preparer on the return, I would say that is a red flag. How long have you been preparing tax returns? Again, trying to get at, you know, what is their knowledge in this area? will you provide me with a complete copy of my completed tax return? You know, again, that's something you have a right to have. You should get a copy of the return that's being filed so that you can see, you know, what's been done on your account. How do you learn about new tax laws? Again, sort of getting at, okay, what's, you know, how well are you educated on, you know, tax and tax laws and tax principles? And then lastly, if someone from the IRS or the state contacts me, are you going to be able to assist me? So is this just like a one and done and then I'll never hear from you again? Or are you actually going to be around because you're a more well-established business or return preparer? And then in the yellow, I'll just reiterate this again, you know, you're responsible for the information that's being submitted on your return. If you're signing it, there's an expectation there that you've reviewed the return. So if there's something wrong on the return and you're getting a refund that's bigger than you should, and the IRS catches it, you will owe that money back plus penalty and interest. Whether or not you knew what was going on. Like if you thought the return was legitimate and it really wasn't, unfortunately, you're going to be held responsible if you reviewed that return and signed it and submitted it. Okay, and lastly here, I've got our clinic's information and my information. I'm happy to answer questions. If you ever have any, you can reach out to our clinic. We're happy to provide advice. One thing I didn't mention that I should have at the beginning is that although we provide free legal help, our clients do have to qualify for our services just like they would with legal aid, except our requirements are up to 250% of the poverty line. So for a family of one, that's around $30,000 or below. For a family of four, it's around $60,000 or below. So we go by household size. So usually, you know, we still have many, many clients that, you know, fit those income requirements, but I just wanted to make sure to mention that as well. And with that, thank you so much for having me here today. If you have any questions, I'm available. And then I'm also happy to provide the presentation so that you can, you know, provide it as a resource if you've got any folks you're helping that, you know, think could benefit from it.
Nancy, thank you so much. I think I'm probably not alone in saying that tax filing for everyone can feel so complicated that hearing more information about how to tackle this and how to help others tackle it, it's really empowering. So thank you so much for being here and helping us think through this complicated, really important system. We probably have time, I think, for one question before we're going to take a short break between sessions. So is there anything that's coming up for folks? You're welcome to stick up a hand with your reaction or unmute yourself or stick something in the chat. I think maybe, Nancy, just to finish this one question I might ask, because you laid this out so nicely for us, sort of thinking about areas in which folks with and without social security numbers might be needing to think about forms differently. I wondered if you had any advice for supporting folks who might not have access to a social security number, even if it's just very basic principles about how to be supporting people in the tax process.
Sure, that's a great question. So if someone's not eligible for a social security number, they can apply for something called an ITIN or an income tax identification number. And there is a form that they would fill out, Form W7, and they would actually attach, they can file the tax return. It's a requirement that you have some sort of federal filing requirement in order to request the ITIN in most situations. So you would actually attach the tax return to the ITIN to apply for this number. We do have more resources on that, so I'm happy to also follow up with those. But the point is that just because someone doesn't have documentation to work here doesn't mean they can't work here. And also, if they are working here and earning income, there is an expectation that they report that income to the IRS on a tax return. So they can apply for an ITIN for themselves, for their children, if their children aren't eligible for ITINs, just be able to, to be able to file and receive that tax benefit. The ITIN is not interchangeable with a social though. So it does not, should not be used for other things like applying for loans or, it doesn't qualify as like a social security number when you're trying to get a W-2 job. So there definitely are some limitations there. The main purpose of that number is to be able to file a return especially for folks that are trying to maybe get citizenship down the road here and build that history of complying with the US laws, one of which being like the US tax laws. I know that is something that judges will look at. They want to see that you've got a filing history, that you're, you're here, you're abiding by the laws of the country that you're living in. So, I think it's important that folks keep that in mind, that, that really can be important down the road for many different issues, for many different reasons.